Hello, everyone. Welcome to the sweep. I'm your host, as usual, Hiram Cherez. We're going to go ahead and get started here in just a minute or so. Feel free to look over the disclosure while we wait. As you guys get settled in, feel free to introduce yourselves or say hello on the chat, and we're going to go ahead and get started. All right. Okay, so as usual, like, share, and follow on social media, facebook.com/daytradesmart, instagram.com/daytradesmart, and the number 1, youtube.com/theprovingground, which is, of course, where you are now. And if you have any questions beyond that, you can also email us at info@daytradesmart.com. Okay, so today we're going to talk about automated trading, right? Do bots and AIs work for auto trading? Okay, this is a question that we get really often because of our software, because we're able to do with our indicators. You know, people start asking, well, you know, if we've back tested and we've done all this work, is there a way just to program that information in and have something just take the trades for you when they occur? And so we're going to address some of that. And I'll give you a short answer really quickly as we get into this. So first, let's consider what we know about the day trading markets. Okay, but let me give you the quick answer first, because I want to start with this. I want to preface with this quick answer. Do the bots work? Well, first it depends on how you define work. Do they function in that they can be programmed to take a trade for you when all the parameters are present? The answer is yes, absolutely, 100%, and they'll work flawlessly in terms of carrying out that process, right? You say, okay, when I've got this set up, when these things happen with the indicators or with the market, whatever it might be, I want to be put into a trade for this many pips and this much stop loss and use this, this lot size for my risk, right? It will do that, but I think the real question is, do they work in terms of being profitable? And that's a whole other topic altogether. So do the bots work in being profitable? And so if your process, if your setup is going to work, then it would stand to argue that it should work if a bot was trading it, right? But there are a lot of other things that come into play, and we're going to talk about some of these things. So again, let's consider what we know about the day trading markets. First, it's a zero-sum game, right? So that means in order to buy, there must be sellers. In order to sell, there must be buyers. This rule applies to everyone, including hedge funds, institutions, etc. So even the big players have to follow that rule, right? Major players, organizations such as hedge funds and the like, are experts at keeping their profits by way of counter-trading traditional trading methods, okay? They're aware of the traditional trading methods, right? Support, resistance, trend, channeling, Fibonacci, RSIs, EMAs, all that stuff, MACDs, right? They're aware of that stuff, right? And they make their bones by counter-trading that stuff on a regular basis, right? Because it's a zero-sum game. So if they have to follow the same rules, if they've got, let's say a hedge fund has, millions of dollars, let's just say $1 million, right? And they want to put in a trade that with that leverage, right? And you've got a whole bunch of other traders, none of which have that kind of leverage, but collectively could have that kind of leverage. Well, then you would rely on the collective, right? So let's just say, I don't know, let's just say 100,000 traders, okay, trading at, a 1 lot or a 2 lot, let's just say 2.0 lot, right? So, $100,000 traders or 100,000 traders trading at a 2 lot, right? And they're selling. Well, then that gives the big institutions the ability to go the other direction. So they want to know what these traders are doing. Well, the best way to know what those traders are doing, and we'll talk about some of those ways, but is to teach the traders how to trade, right? So a lot of this stuff that you know about, you may not know where it comes from, right? You may not know how it started or who introduced it. And that could be the exact tool that the bigger institutions are using to counter trade you, right? If they know, okay, there's a resistance level or there's a trend and it's going up, and a bunch of traders are going to see this and they're going to want to buy, and they can do the opposite because they know that they'll have the leverage to go the opposite way. And it goes, the nefarious dealings of the institutions go much further than that, and we'll talk about that as well. So major players, right? Regulation. We know that when the word regulated is used, it usually applies to the retail trader being regulated and not the institutions. Okay, it's not that they're not regulated. That's not the issue. It's not that they're not regulated in that they can just get away with whatever they want. Everything's regulated. It doesn't matter where you go, whether it's the U.S. or overseas. They're all regulated. And if they want to do business, for example, overseas brokers, if they want to do business with U.S.-based brokers, they're regulated, right, based on U.S. regulations. But when we talk about regulation, a lot of times when people throw that word around, it's usually the trader, the day trader, the retail trader, us, that is regulated, right? And we'll talk about some more of that here in a moment. Algorithms. Institutions use algos to search and destroy trades that are uniformly entered into the markets when the amount of such trades begins implementing, or when the amount of such trades begin implementing larger trades, right? So the use of large lot sizes and or significant amounts of contracts. Okay, so we're gonna touch on that here in just a moment. And then disinformation. This is one of the biggest ones. Major players are well known for using announcements to hide their big moves. Additionally, they are responsible for developing most of the foundational trading methods known to retail traders. So we just talked about that, right? So let's look at some examples here. And I want to pull up some obvious ones, and I meant to pull them up before this session. So because I didn't, I'm just going to use an example of a candle that would look the part, basically. So I'm going to use this example first. We can see that something abrupt happened in the market here in these two candles, right? How do we know that? And it could be because there's a market open, right? Because that 1800 UTC is, let's see, 12. So that's like 1200. So this is going to be like, noon. So 11 to 12 Mountain Time. So that's like 1 to 2 Eastern. So where it's in the middle of the afternoon right here, I can almost bet that, and we can go back to that date, and we'll look at that in just a little bit, that was some type of Federal Open Market Committee announcement, FOMC announcement, right? And we'll go back to that date in a Forex calendar and look at it. Okay, so we can see that it started off with some posturing and then had a continuation, okay? And the speculation is if the FOMC is going to keep interest rates low, for example, or start decreasing interest rates, then that devaluates the value of the dollar. Now, this is the euro versus U.S. dollar, which means if the U.S. dollar is devaluated, then that means that the euro and other currency pairs will strengthen against it. So this would go up, right? Because the euro would strengthen and the dollar would weaken. Okay, and so the speculation then is that if that happens, then that is kind of the overall, that's what should continue to happen, right? Because now the dollar is speculated to become weaker, right? And that's one example. I'll show you a couple more examples. Before we do that, let's go into, and I've showed you guys this before, but we're going to go into Forex Factory. Now let's just look up that date. So let's go here, and we're going to go to March 17th, which is a Wednesday, just as I expected. And right here, March 17th, what do we see? FOMC economic projections. I mean, I just went to a random candle, but I could just, knowing the time that it happened, I mean, if we look at that, look at this. Look at everything that happened before that, right? It's all really soft and sideways, not much going on. This is hours and hours, right? Even these candles, just a lot of soft and sideways. There's posturing, positioning. They don't know what the FOMC is going to do, what they're going to announce. Let's take these two candles right here from shadow to wick. That's about 87.7 pips, okay, in 2 hours. From this top to this bottom is about 107. So let's see where 87 is. 87 is about right, right there about, right? So for the market to clear 87 pips in one direction, it took, in this case, it wouldn't be 4 days, it would be 2 days because there's a weekend right here, 312, and then it jumps to 314, right? So it would be about 2 days, over 2 days, that it would have taken to move just in that one direction, 87 pips, right? 88 pips from there to there. And in these 2 hours, it did the same. Right? So we can see that something abrupt happened there. And then just looked at the time, and then that made it very evident that it was a result of FOMC economic projections and federal fund rate, which again, look, it stayed, the forecast was it was going to stay less than 0.25%, and it stayed less than 0.25%. So here's the rub. Sometimes that's going to be correct, and that's going to strengthen the dollar or weaken the dollar, and other currency pairs are going to strengthen versus the dollar. But when we look at the overall, it really didn't move up much further than that, right? I mean, after some time, it retraced. And if we look at from there to where we are currently, right, we didn't go up. The dollar didn't continue to lose value. Okay, matter of fact, that was the highest point that we got since then. It never went back to that level. And now, if we look at just calendar days, we're talking about, almost a month, 23 calendar days, right? So let's look. I want to find an example of a candle that I can use just as an example. So it may not have occurred there, but it'll stand as an example. Let's see. I want to find a good one. There we go. So let's say that you've got an announcement coming out, and the announcement is supposed to strengthen the dollar, right? So theoretically, it's supposed to pull the market down, or it's supposed to go, up, right? Let's say in this example, it's supposed to weaken the dollar, and the market is supposed to go up, right? And the announcement comes out, and traders decide that they're going to go up, buy, and institutions decide, well, since that's happening, we're just going to go the other direction, right? And there are other situations where traders might try to get a jump on things and start to sell, and then the institutions will say, okay, that's just what we need, now let's pull it the other direction, right? And they start going the opposite direction, right? So what is causing that? That's the real question. How is it that they're able to get away with that? How is it that that's being caused, right? So let's look at some of that. So some examples would be like GameStop. Well, after the fact, I would say. But GameStop serves as a good example, and I'll explain why. So after the fiasco with GameStop, institutions began lobbying for laws that would prohibit this type of market manipulation, quote-unquote market manipulation. Ironically, this is the exact type of manipulation they employ as a standard. This is what they do. This is the type of stuff they do. So what happened was called a short squeeze, okay? I don't know if you guys are familiar with what happened with GameStop. But if you are, essentially what happened is you had all of these hedge funds and all these big institutions that were putting their money for their clients in certain stock, buy, sell, long, short, right? Well, for GameStop, it had consistently gone down in value, right? So they were shorting it with their clients' money, right? Well, these guys got together and decided that they were going to collectively get together, put the word out there to buy GameStop stock. And it caught on. It caught on like wildfire. And a whole bunch of people started buying GameStop stock, which caused for this asset that was depreciating to then start to spike up. And this is what's called a short squeeze, right? Because as it starts to come down and more people start to buy into it, then these hedge funds and these other accounts start to hit their stop loss or their risk tolerance, right? So as those trades start to come out of the market, right? So remember we were looking at that scale before. If you guys have watched the first couple of series on, what is day trading, day trading for beginners, as those sells come out of the market because they hit their tolerance, their risk tolerance, then there's now more weight going up, right? There's more buying than selling, so then that causes for the market to continue to go up, right? And so what these hedge funds and different institutions had to do was hedge their losses. So then they were forced to get into buy positions, okay? So at first they're selling, and then the market starts to go up. And when they hit their risk, they get out of their sell positions. So that causes for the market to go up even more aggressively. And then in addition to doing that, they had to get into buy positions, which caused the market to go up even further. Okay, so now you've got retail stock traders that are buying. You've got institutions that are now buying to hedge their losses, and so it's skyrocketed, right? All in all, the institutions, the hedge funds, they lost billions. Okay, the guys that did this, the guys that decided to buy GameStop are my heroes. They're awesome. That's awesome that they did that, right? But as soon as they did that, that was it. Like now they're lobbying to stop that from happening, which is ironic because that's what they do. That's what the institutions, the hedge funds do, right? They wait until everyone is going in one direction and then they do the opposite, or short squeeze or whatever it might be. Right, so that's kind of their game plan sometimes, but they don't want laws that would prohibit them from doing that because I don't know if you know this, but they have special rules that apply to only them. You're regulated, right? You can't do some of these things, but they can because they're institutions, okay? And part of it is it's not all. It's not. Some of it's not nefarious. Some of it's necessary. And we need for these markets to function correctly, right? Because that's just how our economy works. But it goes beyond that. Because when you start legislating so that the big guys get an even bigger advantage towards the little guys, that's nefarious, right? And we'll talk more about that in a moment. So another example would be selling the rumor, okay? So check this out, and you guys can look this stuff up, all right? You don't have to take my word for this stuff. This isn't like I'm not running a conspiracy theory podcast here. This is real stuff. Just people don't know where to look. You wouldn't think to look for these things, right? You just have to know the industry. You have to be around it long enough to know, right? And have somebody that's gonna be willing to tell you about it, and then you can go and research it because now you know what you're researching, right? Okay, so a common practice for retail traders is called buy the rumor, sell the news. Okay, so this is a really common practice. It's something that a lot of traders, especially in stock and things, will do. And so the idea is that they will wait until there is speculation by reputable sources, right? Let's say, for example, we're just looking at Forex Factory, right? So we could even go as far as clicking on some of these and seeing, what some of these sources are saying, right? And if we trust these sources, then we can make our prediction on what the market is going to do when that announcement comes out, right? So let's say the FOMC announcement right here. Okay, so we say, yes, we know that, and normally this is a red announcement, by the way, but it was an orange because it was, everyone knew what was going to happen, right? So everyone knows, all the economists, all the speculators, all the analysts say, yes, the FOMC is going to keep the federal fund rate at less than 0.25% because of the current economic forecast. So let me explain why, really quickly, why this affects the markets and how it affects both economy and currency, okay? Let's say that you've got a bird, okay? And this wing is currency, right? And this wing is economy, okay? And this is the U.S., right? This is the eagle. It's the American U.S. bald eagle, right? That's not Elon. That's econ. Okay. So you've got currency on one side. You've got economy on the other side, okay? Now, when there are certain things that will affect one positively but negatively affect the other, okay? Rate increases, when the banks increase interest rates, that makes the currency stronger, okay? Now, I'm not talking about the interest rates that you pay. It's the interest rates that banks make for the money that for your money, right? So if you have a savings or you've got a checking, you got whatever money you have with them, there's overnight swaps that they can get percentages on. There's having that collective of money within their institution that they can make a profit on, a percentage of profit on. So when the rate increase is up, when it's higher than, so for example, right now it's less than 0.25%, then they're making more. So let's say it's 1%, then they're going to make 1%, right? So if they're making 1% and you have to borrow money, but they're making more than they were before, then they're going to be more stringent about how they lend that money out. That means that you're going to have a better credit score. You might have to have some type of collateral, a co-signer, something, right? Otherwise, you're not going to be able to borrow money. And if you do, and when you do borrow money, it's going to be at a higher interest rate because they're already making money just letting it sit there, right? They're making more just letting it sit there than they did before, okay? So that affects the economy because if the currency is strong, this wing is strong, the economy is going to weaken because less people can get loans to buy a house, to buy a car, to start a business, to go on vacation, whatever it might be, right? So then it hurts the economy, okay? Now, there are other things like, let's say, low unemployment, okay? So there's not a lot of people that are unemployed, right? Low unemployment is one of those things, one of the very few things and a handful of things that help both currency and economy. So both wings of the bird are strong and it flies high. Low unemployment. And so this is another thing that we'll see in an economic calendar, right? And there are different types of unemployment numbers. Employment change right there, as a matter of fact. That's for the Australian dollar, but unemployment rate, right? So this is the employment change. This was the employment rate, right? So you can see the red announcements. Red is the highest impact. White or gray are the lowest, followed by yellow, then orange, then red. So you can see they're ranking up there with economic projections, FOMC type stuff, or GDP, right? Gross domestic produce for the quarter. Unemployment, that's going to matter, right? And you can see when it's when the actual, this is a smaller number than the forecast, it's positive, it's green, because you want low unemployment numbers. Here, you can see that this number is less than that number and it's red, where this number is less than that number and it's green, because you want this number to be lower than that number. Here, you want this number to be higher than this number, right? Because that's a good thing, right? So I want you guys to be able to see that and read that. Why? Because not because I want you to trade announcements. Matter of fact, we recommend that you not trade announcements. You don't try to get into the market when announcements are happening, because it's a gamble. It doesn't matter if you think you know, right? So now that we understand how this kind of works, if the FOMC were to have said that they were going to, or they increased, let's say they increased interest rates, right? The forecast was that they were going to keep them the same, but they increased the interest rates. That, by definition, would mean that they are going to, that the U.S. dollar should strengthen, right? The U.S. dollar should strengthen by definition if that number comes up, right? Higher than the forecast. Okay. So let's say that everyone, so on that example, everyone expected that the FOMC was going to keep the interest rates the same, which means that by default, the U.S. dollar, it doesn't have a good outlook. It's not going to strengthen, so it's going to remain weak or soft, right? So if traders know that before this announcement comes out, which would be 12 p.m. Mountain Standard Time, and it was on that date, right, March 17th. If traders know that before 12 p.m., then they're going to plan for that. They're going to try to buy the rumor. They're going to try to get into the trade early, right, like they did in that example that we were looking at. Let me try to find it again. Actually, I know where it is. It's 317. Oh, I passed it. So they're going to try to get in earlier than before the announcement comes out, right? And so we can see some of that right here on this candle. We already started to see the move, okay? And then based on their sell the news, if the news comes out and it is still positive, then they'll wait for that cap, right, that high, and then they'll release their trades. They'll get out, take profit, and the market will pull back down. Or if it was moving down, it looked like this, right, like that other candle we were looking at. And this is like a red candle. And this is, how far it went down. They got out of their trades there, and that caused for it to pull back up and end right there, and then go on to the next candle, then go up, right? Okay. So this is their plan. Their plan is they're going to buy the rumor, so they're going to get in early, and then if the news is positive, they're going to stay until they see the cap, and then they're going to get out, right? Okay. So if banks, if hedge funds, institutions, if they know that everybody thinks buy the rumor, so they're going to buy, right? So in the example of the U.S. dollar, the euro, let's say the EU, or let's just say the U.S. dollar, just the U.S. dollar currency, not foreign exchange, just USDX, right? Just the currency. Because you can trade just the USDX and not an exchange. You can trade just U.S. dollar. You don't have to have like a foreign exchange trade. You can trade just the or just the U.S. dollar. So let's say it's the USDX, and the FOMC says they're not going to increase interest rates. Well, then traders can short the USDX, and then they'll go long on gold, okay? Because gold, even though we're not gold backed, right? Our dollars are not gold backed anymore. It still runs opposite of the U.S. dollar. So they go long on gold and they short USDX. Okay? So what the retail traders do is what's called excuse me, dry throat. Is what's called selling the rumor. So they're not buying the rumor or selling the news, they're selling the rumor because traders are buying the rumor. You see? So traders will say, okay, the rumor is that the US dollar is going to lose value. And so we're going to go sell on US dollar and we're going to buy gold, and the banks will sell the rumor instead of buy it. So the institutions will then go long on USDX and short gold because they know they've got all those traders, right? 100,000 traders, like we were saying, 100,000 traders, millions of traders, not just 100,000, but just say 100,000 traders trading in the same direction, with various lot sizes. That means that they have counterweight. Now they can take their big, huge dollar trade and put it in and go the opposite direction and wipe these guys out for that trade or for multiple trades or for whatever it might be. Hopefully you have protection, when that stuff happens. But this is a common occurrence, so common that there's names for it, right? And these are common practices, okay? So you want to be aware of these things because that will encourage you to stay away from trying to trade when these announcements are coming out. Okay? There's a couple of other things that you should be aware of when trying to trade announcements. There's first in, first out. There's slippage rules. That means that if you press, let's say, this moved up really fast. Let's say, for example, actually, let's replay it. Let's see if it did move up fast. So let's go here and replay from there. Okay. Because this is important. I want you guys to see this. Oh, now it's going to take forever. Okay. That's all right. We'll be patient. Okay. So let's look at a smaller chart and see when it really took off. Oh, let's see. Oh, it's going to show me live, of course. Okay. So let's go 1720. That's going to be 17 and 01. So not much there. Let's see when it really starts to boom. Right there at about 17:55, 5 minutes before the top of the hour, of course, right? So let's fast forward this. This one right here. Just go 500 times the speed. And let's get down to about there. Okay. So in about 2 minutes, it really starts to take off, right? Right there, moved up about 20 pips, okay? And let's just mark this. Let's say our entry would be, let's say we had a pending order, 1.19082. 1.19, this is why I'm not a fan of pending orders either, 082, okay? So let's say that would have been our entry. Let's see, 1753. Oh, of course, because it ended at that point. Okay, let's see if it goes further than that. Yes, it does. Okay. So let's just go to, I'm going to pause this for effect. And let's say our entry is 1.19284. 1.19284. 1.19284, okay? So we have a pending, where did that go? Oh, way up there. Is that how high it went? 1.19284. 1.19284, okay, I guess this one hasn't taken off yet. Okay. Nonetheless, 1.231. Okay. So let's say that that's our pending order. Okay. And as the announcement nears, let's get closer to it, the market starts to take off. Okay. It's probably going to be, I don't feel like I have this linked very well. Okay. Let's just wait for it. And let's say, I'm going to move this because I know it should take off here soon, but let's just say that we've got a pending order somewhere here. I want it to blast through it. I'm not sure how fast it moves. So we've got a pending order, and we're basically just waiting for the announcement to come. And a pending order just says, when it reaches this level, get me into the trade. Okay? So right there, like in a blink of an eye, it just shot up, right? In the blink of an eye, it shot up. Okay, so here's what happens, and this kind of stuff only happens during announcements and stuff, where I mean, it can shoot up and you know, work very aggressively, but generally during announcements you're going to see more of this slippage and first in, first out. Okay. So as it shot up and it crossed your line, theoretically, in a demo account for sure, you would have been in that trade at this price exactly, okay? Where in a live scenario, it's going to wait until it finds a level to put you in at, because there's no buys available. So it has to wait till there's a drop, some traders come out first, and then puts you in. Now, if you're the only one in the entire world that did that, then you would get in as soon as you see the first drop. But if you're one of thousands of traders that try to do this garbage and it doesn't work, then you're waiting in line, right? So as it drops, then however many traders are in front of you, they get in, and then it's got to go up, and then it drops, and so on and so forth, right? And you want this to go, you want it to buy, right? You want it to go up. So this is for a pending buy, and when it crosses that line, you want it to be put into a buy. And you're sitting here holding your breath, and you're waiting for your buy to be executed, and you're not in a buy yet, right? And it came down a little bit, and some traders got in, but you're still not in a buy, and you're still waiting for your buy. Maybe you got in there, right? And now it's starting to come down, right? And that happens, and sometimes that's enough to stop you out, and now you're out. You wanted to be in down here, but instead it got you in at the first available place. Okay, that's something you won't know if you've only demo traded, by the way. And it happens most prevalently during announcements. Okay? I'm not saying that it can't happen outside of announcement times. It does. There's things that happen that cause for it to be erratic, but it's not regular business as usual. The only other exception is if you're using too large of a lot size on a currency pair that can't sustain that lot size. Okay? So another thing you want to be cognizant of, and that's why we use specific currency pairs when we trade. So we're going to stick to currency pairs that have enough volume and liquidity historically to support larger trades. So because our traders will start off trading at a small lot size, 1.0 lot, which is $10 per pip, and then even go up to 100 or more pips or lots, which is $1,000 per pip. Right, or more. So, not every currency pair can support that. You'll have what's called slippage, where if you have a take profit right here for, let's say, 100 lots, right, and the market moves, let's say this is your take profit. Actually, let's use this as an example because we know this goes up. So let's say we got in here and we were going to get out here, okay? And that's for a total of 10 pips, okay? So we used a 100 lot on some offhanded currency pair, right? Even something that sounds like it should be a major pair, like let's just say the Euro JPY, right? So you have 100 lots, okay, which is $1,000 per pip, which means for that 10 pips, that would be $10,000, right? So you would make 10 grand on that trade, okay, for going that 10 pips. That would be what your take profit would be if you went from here with 100 lots to this line right here, Okay? This black line is going to represent our entry. That's where we entered. That blue line, we should be awarded 10 grand because 100 lots for 10 pips equals $10,000. Okay? Now, when you get there, there aren't 100 lots. There aren't, enough lots going the opposite direction, right? Because you got to sell them. You got to take profit, which means the sellers will pick that up. Okay? If there aren't, and let's say it says, okay, right down here, I could fill 90 of those lots. It's going to say, nope, can't fill the whole 100. Where can I fill the whole 100 lots? Oh, right here, right? And it will give you the profit to that point. You went up this much, but it could only fill 100 lots here, okay? Which, by the way, would mean that you would lose that 6.7 pips at $100 a pip, or $1,000 a pip. So that $6,700 you would have lost. You would have lost $6,700 in that example if that's where it had to take you out in profit. This is called slippage, okay? The reason why you don't hear a lot of traders talking about that online and stuff like that is because they don't know about it. Do you know why they don't know about it? Because they're not actually trading successfully. It's just the way it is. They don't know about it because they're not actually trading a live account successfully. Right? We've talked about ways to be able to separate the wheat from the chaff, know when somebody's telling you the truth, know when they're lying to you. This is a great way. Some of them, you'll know that they're telling you the truth if they say, yeah, I'll put in 100 lots, but not all at once. They'll say, I'll take 10 trades for 10 lots each. So right here, they have a lot size of 10, and they just push the buy button 10 times. Boom, 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 right? And so now they're in. So when it gets there, maybe the market can only fill, 10 of them or 2 or 3 of them at that level, and then 4 or 5 of them at another level, and then 1 or 2 of them at another level, right? So it'll fill them in wherever it can. But if it's all together, it's going to want to fill the order all together. So they'll put in multiple trades simultaneously to fill their so that they're more guaranteed to get as much of that profit as possible. Okay, and that's smart. That's wise, and they're familiar with what they're doing. Everyone else that tries to claim that they know what they're doing, and they're putting in larger lot sizes, and they're trading on major currency pairs or the like, are lying to you. They're not successful traders. They don't actually trade at that high of a lot size. They're pulling one over on you. That's just not the way it works. They would lose money. Okay, so just another way to be able to, again, separate the wheat from the chaff. Know who's telling you the truth and knows who's trying to pull one over on you. Okay, so I know we kind of took a tangent, but it's relevant to what we were talking about with selling the rumor, right? Because all those things come into play when you're trading. All of those things, right? And the institutions, they don't have to abide by some of those rules, with the exception of zero sum. Obviously, they have to. That's why you have to wait for some of that stuff to happen, right? And CFDs and options brokers most prevalently trade against their clients. You did not hear that incorrectly. You heard that correct. They trade against their clients. This is completely legal because they are not regulated, okay? These are some of the most highly regulated markets in the world. Most highly, CFD options, highly regulated markets in the world. Again, the retail trader is highly regulated, not the broker. Although there are regulations imposed on the broker, the most negatively impactful regulations are imposed on the trader. I'll give you another example. Some of you guys might have heard of Dodd-Frank during the Obama administration. So Dodd-Frank was the Consumer Protection Act, right? And it was designed to protect the consumers, right? And it gave you the warm and fuzzies. For day traders, wanting to use U.S., let's say Forex day traders wanting to continue to use U.S.-based brokerages, it handicapped them, okay? So before we talked about leverage. So you can get a broker that will give you up to 1,000 to 1 leverage for Forex trading outside of the U.S., okay? I recommend a 200 to 1 leverage. That's the nice sweet spot, okay? And if you're using money management, you'll never use 200 to 1 leverage on one trade. Matter of fact, you'll probably use like 11 to 1, you know, something like that, right? But what this helps you with is the various margin percentages per currency pair and allows you to put in multiple trades, okay? So you guys remember in one of the other sessions that we did, we talked about how margin is affected by the lot size that you put in, okay? So this is another way that stops traders from being successful, because if you've got, let's say, well, let's use the 200 to 1 first, okay? So we've got a 200 to 1, and let's say we're trading on the euro versus US dollar with a 200 to 1 leverage, and it's 100% margin requirement. So it's going to be about $650 roughly that we're going to use in free margin, okay? Now, if I use a 1.0 lot, it's going to use $650, which means if I have, let's say, a $10,000 account, right, just pushing the button to buy or sell, my free margin is going to be less $650, right? So that's going to equal, you know, roughly $9,350. And then there's spread and, you know, so on and so forth. But let's just not look at those for just a moment. $9,350 is what I have in free margin, which means if my trade goes negative up to $9,350, then I get margin called. I get taken out of that trade, and I get left with only $650. Okay? Now, let's say that we have, after Dodd-Frank, you couldn't use, with a U.S.-based broker, 200 to 1. The max you could have is a 50 to 1. Okay? Which is 4 times less than that, right? So 650 divided by 4, that's going to be 325. So 100, you know, what is that? 112, or sorry, not divided by, times. So what is that? 25, 26, right? $2,600. Okay. So $2,600. So instead of having $9,350 in your $10,000 account, you have $7,400. $7,400 in your free margin. Okay. Which, no big deal, right? Again, you should be fine because you should be using money management. But what happens if you have to put in another trade or possibly 3 trades? You wouldn't be able to. You would run out of margin, right? So it matters how much you have there. So that means that to put in the same trades, if I know that sometimes I'm in 3 trades, then I've got to decrease my lot size because I only have a 50 to 1 leverage, right? So my lot size then would become like a 0.25. So 0.25 would decrease the margin requirement because it's not a 1.0, right, by 4 times. So then I would be closer to this number. So that means that even if I trade really well, I'd have to use a really small lot size, okay? And I've got a significant account. I'd have to use a really small lot size because my leverage is maxed at 50 to 1. So why is this done? Well, because it makes it easier for the banks to beat you, for the institutions to beat you, to push trades in another direction, not have to go so far to push it in that direction in order for you to stop out, in order for you to run out of money. It makes it easier for them. The other thing that you can't do is you can't hedge. So there's a method in which you can put in a counter trade, right? You have a buy on the Euro USD for a 1.0 lot, and it starts going the other direction. So you put in a sell on the Euro USD for a 1.0 lot. This is called hedging. So you don't have a take profit here anymore. You don't have to take profit here anymore. Now let's just say this is 10 pips divergent. Then even if this goes down 1,000 pips, you're still 10 pips negative, because this trade would be negative 1,010, and this trade would be positive 1,000, which would be the difference of 10 pips. And then when you're ready to, when you feel like it's going to go back up, then you can price average. There's a number of things you can do to get out of a hedge, right? And save your trade or make profit. But you can't do this on the same currency pair on the same account in a U.S.-based brokerage. You can't hedge. So I can't put in a buy and a sell, or if I have two different setups and one of them is, for a buy, the other one's for a sell, but I have room with my stop loss that I could hit the buy and still hit the sell and make profit on both, right? So let me give you an example. Let's go to our green chart. Most of the time I don't even expect that you guys can understand what I'm scribbling. I just talk with my hands. So don't feel like you're missing something if you don't know what I'm scribbling. I'm just talking with my hands. Okay. So let's say that we've got a trade, and let's just measure one. Let's set this up. Let's say that we've got a trade that we can buy for 10 pips, and another trade that we can also sell for 10 pips. Okay, and our take profit on either of them is 20 pips, or our stop loss, sorry, on either of them is 20 pips. Okay, so I put in a buy trade for 10 pips, 118.863, so 963, right? 963. So I have a buy here for 10 pips, and my stop loss is 20 pips, so 118.663. Whoops. Okay, that's my stop loss for that trade. And then I've got another trade that I can sell. So I'm just going to put it here so we can see it. Okay. Yellow sucks. Okay. Let's go pink. Okay. So that pink line is my sell. I'm going to sell. And I'm going to sell 118.843 for 10 pips, so 118.743. Okay. And my stop loss is going to be 118 or 119.043. That's my stop loss. So I don't want to hit either of those red lines, but I do want to hit both of those blue lines, right? Next candle comes out, and it touches both lines, right? You can see we would have taken profit there, we would have taken profit there, and we would not have touched that line or that line yet. Okay? So we would have won. We could have put both trades in at the same time and would have won both of them. Okay? So it's not just a hedge that would cause for you to want to put in a trade in both directions. Sometimes it's because you have a setup in both directions. Okay? With the U.S.-based broker, you're not allowed to do this. You can put in either a buy or a sell, but you can't do both on the same currency pair. This is the Euro USD. At the same time. Okay? Because it makes it more difficult for banks to get you to a stop loss or get you to run out of money if you can protect your trade or if you can take trades in multiple directions. It's more difficult for them to manage that. And if you look at Dodd-Frank and you read it, you'll see very clearly that it was designed to handicap the professional day trader, among other things. It wasn't just a professional day trader. That is not a Consumer Protection Act. It's garbage, and it hurt traders. So a lot of traders use brokers that are overseas, which is completely legal. It is absolutely legal, okay, for you to go to a broker overseas and trade with that broker, even as being a U.S. Client. It is lawful. It is not against the law. Obviously, you want to be careful of the brokers you use, and we'll talk about brokers at another time. But you can see that all of those things like Dodd-Frank, like the regulations that are placed on traders, by government, by institutions, are set in opposition of you. And then on top of that, they can trade against you. Now, that's a conflict of interest, right? Because they're the only ones that can see which way you're trading. They can see how many lots are buying, how many lots are selling. Now, some of that, of course, is necessary. They're going for kind of a zero offset, and so if there's 100,000 lots to the buy side, then they're going to put 100,000 lots to the sell side, or they're going to pass on that risk to a larger institution. So some of it is and you guys can read up on some of this. It's like A book brokers and B book brokers, things like that. But there's nothing to stop them from just trading against you. Now, is it their common practice? In other words, 60, 70, 80% of their trading? No, 60, 70% of their dealing is just offsetting your trades, and so that risk is carried, and then they zero out, so they don't lose anything, but they're not trading in opposition of you in order to make a profit, right? Yes, that is pretty standard business, but there are other situations where they are intentionally trading against you to take advantage of you, right? And sometimes it's by way of just looking to see where the amount of trades are moving and then go the opposite direction. Other times it's knowing how you trade, right? And so if we looked at, let's just say, and if you guys have watched any of my other stuff on YouTube, you guys would see some of this stuff that we've kind of illustrated for you. But let me just see if I can find. So there's an example that I used in one of those videos, so I just want to review that one. Okay. So they know that people like to look for trend, right? So they'll keep track of essentially what the trend is doing, right? So if I were a trend trader, then I'd be drawing out, some lines to represent where the channel is, right? Am I in a buy channel, a sell channel, whatever. Uptrend, downtrend. So you can see this is a downtrend, right? And then support and resistance. Another really popular one. So we've got some levels of support and resistance right there. You can see through there, right there, right up here, right there, right there. Let's just draw another line up here. Okay. Now, we can see that there's a couple things happening here. We can see that we hit the top of a trend line, which if we follow that trend, when we get close, we start to come down, right? And if we go back on that trend line, we can see that that's what a trend line is for. So we hit the trend line and had a significant pullback, right? It came all the way up to here and then pulled all the way back on a level of resistance, okay? And we can see that that's a valid level of resistance, okay? And then we've got price action, and these are all things that I've taught you guys and taught you why it's garbage, but have showed you guys, right? This low is lower than the previous low, and this high is lower than the previous high. So down, down, right? So now you got price action. So a lot of those traders are looking to sell, right? And there's not much about that says they shouldn't. I mean, by all accounts, that's all it's been doing, right? There are other trade setups within there, but this one's just makes the point that I'm trying to make. So right here, we can see, oh, not that one, that majors, the big players, are just releasing trades, allowing for the market to soften and give that price action. Why? Because they know that the miners are looking at the resistance, looking at the trend, looking at the pullback, getting in with the price action. So they want them to do that. Why? Because it's already overbought. They can't go any further unless the miners sell. So now miners are selling. We can see that gray and black, they're selling. The green and red are the majors, right? And so what do the majors do then? And these are indicators. This is how well our indicators work. The majors buy because now they have enough people selling. And what happens? It goes up. The miners crossed right here after crossing down because they hit their stop loss, right? So now we're vastly overbought because miners, all those sells that were in there giving us counterbalance are gone, and majors started to buy again. So we know 60 to 65% of the time the market will still move up a little bit and then start to come down after being overbought so aggressively. So we position, we wait on that next candle for it to go up a little bit, and then we start to sell. And I won't go into positioning and all that right now. You guys can watch the video. And so it moved up a little bit more, and then it starts to sell. Now this is a bootleg. We could, likely take that for a sell as well. But generally, we want to see is both of these then cross down like that. And that's actually it's dirty pressure, which I have shown you guys. And so then we could take another sell. Right? And still, you can see we're outside of that trend line, even after all of that. Right? So did all of that trend, so on and so forth, work? And no, and in a lot of situations, it doesn't. Right? We know that those things work 50 to 55% of the time. Trend, support, resistance, candlestick patterns, all that stuff. That's what it is, 50 to 55% of the time. Okay? So a lot of the reason for that is because the institutions, the hedge funds, they need that counterbalance. And so if they know where you're going to trade because they taught you these things, right? They taught you about trend. And even though you didn't learn it from the institution, whoever's teaching it to you learned it from someone who learned it from someone who learned it from someone. Eventually it gets back to where it was created. And where it was created was by the institutions. Right? So that they've got everybody doing the same thing at the same time so they can do the opposite. Not all the time. It's like Vegas. Right? You hit a jackpot in Vegas. You have winners in Vegas. You may have even gone there and gambled and left with money. Maybe you didn't hit a jackpot, but you left with more than you came with. Because if they just always took your money, you wouldn't go back. And in a zero-sum market, if you always lost, then there would be no counterbalance. Right? There would be no one else to trade against. So sometimes it's just go with the flow, right? You'll see some good market conditions and everything will be just fine, and then abruptly all of a sudden things start to change and you start getting your lunch eaten. Now there's not a lot of ways to tell the difference of when that's going to happen and when it's not going to happen, because it's all based on when the banks decide they're going to do it. That's why if you've got an indication that is not connected to any of those traditional ways of trading, then they work more effectively. That's one of the big secrets of these indicators, by the way. So, again, a lot of things are set in opposition, right? So how do we overcome these things? How do we get beyond these things? Well, this goes back to what we started to talk about, right? Because we asked the question, does automated trading work? Okay? Now consider everything that we've touched on today. If you just programmed a bot, or there's an AI that's picking up on whatever the movement is and just using, because AI is going to go based on historical exclusively and whatever you tell it to go based on, or just candlesticks, right? Unless it's using some type of sophisticated indication that's outside of the realm of normality, right? But a bot, you're basically just saying, look, when you see a candle that's lower, a lower low, you know, and a lower high than the previous candle, then take a sell. Then every time it sees that, it's going to take a sell, right? Okay, so will it work? Yeah, it'll take the sell, but will it be profitable? No, because of all those things. There are algorithms that run out there searching for those things. It's like a sore thumb, right? Think about it. I mean, I could program an algorithm that says, okay, tell me when there's an influx in trades and what that condition is, okay? So if you've got a whole bunch of trades going in 24 hours a day, 5 days a week at the exact same time by the millisecond, that's what a bot does, right? Then that's going to stick out like a sore thumb. It's not going to be like the human element. When you press the buy and sell button, it may vary from, you know, millisecond to millisecond, right? Maybe even multiple seconds. When a bot does it, it's always exactly at the same time to the millisecond, right? And so that's going to stick out to any kind of automation, any kind of algo that's in the markets looking for that. It says, okay, these conditions occurred, and all of a sudden we saw that influx of trading again. And it happens 24 hours a day. We're humans, we have to sleep, right? We're not sitting there waiting for every single trade setup that looks that way and execute on it. So therefore, it sticks out again like a sore thumb. And so those algos pick up on it, and they say, okay, we see that every time these conditions occur, we see an influx of trading. Now, the algo will then just push against it. It'll start going the opposite direction. So your bot will buy. The algo will say, okay, we spotted it, right, after a while, and then it'll start pushing to the sell side until it hits a stop loss. And it may not do it the first time or second or third time, but eventually it'll find your stop loss. And once it finds your stop loss, then it's got it. Then every time that bot puts in that trade under those circumstances, at those conditions, at those times, and it's, you know, within milliseconds of execution, that algo comes in and just pushes the market the other way to where it knows your stop loss is. This is a real thing, guys. This is not, I'm not making this stuff up. You guys can go and research this stuff, right? And this has been more prevalent in the last 10 years than it was in the past, okay? With more, you know, ECNs, electronic communication networks, more things, more advancements in technology, right? Because they've become very good at keeping their profits, okay? And if there's ever a situation where retail traders, you know, as a whole, are going to be able to do something as lazily as they do, they're going to try to create something to offset it, right? Because they've got algos running as well, algos trading for them as well, right? And also counter trading what you're doing. So you can see things are really set up in opposition for you. So to go to the extent of allowing a bot to do the work for you, it doesn't work. I've never met anybody that trades with a bot and makes any kind of significant profit. Maybe it works for a little while, then it makes some profit for a little bit, then eventually it stops working. And their profits are gone. But the other caveat to that is that individuals that sell bots or create bots, if you don't know how to day trade, then even if your bot works great and it would execute accordingly and win every single time, or win, you know, at the appropriate times, if you don't have the correct risk-reward ratio, risk percentage, all that stuff, you're still going to lose, right? Even if it works the way it was supposed to. Because you still have to know how to program. You still have to know not necessarily how to program, but what to program in it, right? What the stop loss and take profit should be, what the win percentage should be. If you don't know these things, you don't know these numbers, then you're just hoping that the bot is just going to get lucky. I mean, I don't understand. It's no different than if you push the button. If your money management is not on par, if you don't know how to back test, then none of that stuff even matters, right? So if most people out there aren't teaching back testing, what's the likelihood that they're programming their bots to use money management, right? So just some food for thought. I really want you guys to consider these things. But do they work profitably? No, they don't. They don't. And there's, again, for all those reasons, right, there's the slippage rules if it gets in at the wrong time. First in, first out. It's the fact that you've got things that are working in opposition of you. There's just so much there that stops a bot from being successful, and a lot of which has nothing to do with the actual setup, or even if it does institute money management correctly. So that human element just can't be automated. It's just too much working against you. All right, guys, I'm going to wrap up with that. And next week I've got some good stuff for you guys. We're going to talk more on what to look for when choosing a broker. Go into some of the other facets of using your MetaTrader 4. Again, I'm not going to recommend I'm never going to recommend a broker, but what you should look for and what you should definitely steer away from. In addition to that, I'm going to introduce my partner Tim Koblin next week as well, and he'll be talking to you guys about some cool stuff as well. So look forward to talking with you guys. Happy trading, and we'll talk to you next week. Thanks.